right, chapter 9. Chapter 9 is in regards to receivables, and it covers accounts receivable and notes receivable, but this video is going to be about accounts receivable. Now, accounts receivable. So as you can see here, there's an example of a company. Well, no, actually not a company. Bob. Bob made a sale to K Gates. K Gates, for $100. And this happened on November 1st, that a sale was made on account to K Gates for $100. And on November 21st, a full payment of $100 was received from K Gates. And number one, record the journal entry for November 1st. Number two, record it for November 21st transaction. So when it comes to accounts receivable, well, I'm going to put it on here. Whenever a sale is made on credit, because this is something that was, I want to say, talked about from chapters 1 until now. So let's see if I can write on this. Yeah, I can write on this. So whenever a sale is made on credit, you're going to debit accounts receivable. So I'm going to abbreviate it as AR we'll say for $500. And you're going to credit some type of revenue account for that same amount. This lets you know that a sale was made on account or on credit, meaning that cash was not received yet, but you are owed the cash. But in the meantime, you're going to have to let it sit in the accounts receivable account. So in this case, you have to figure out who's the customer that owes this balance. And we're going to say ABC Company is the customer. Okay, so this AR here, accounts receivable, is an asset right here. So this lets us know that we have an IOU from ABC Company that needs to be settled with cash as soon as possible. The sooner the better. So when ABC Company makes the cash payment, and we're going to say no discount is applied. We're not going to do the whole discount thing. That is, the discount thing is in what chapter? I believe is in chapter 506. But we're not going to talk about the discount here. So all we're just worried about is how do we deal with the accounts receivable? And we're going to say that the cash payment was made. So if the cash payment was made by ABC Company, we're going to go ahead and debit cash for $500. And we're going to credit the accounts receivable account, specifically ABC Company, by that same amount. Effectively eliminating this receivable balance. Okay, wiping it out. So you'll notice if we draw an X or a line through AR, we see that our cash that was received matches our revenue that was recorded. Now, what happens though when this receivable here of $500 is not collected? So that's going to be what needs to, we need to basically take into consideration that. And this is what this chapter is all about when it comes to receivables, because receivable is just that. It's something that happened on credit that have not resulted in cash received yet. Now, with this example here, this is pretty much similar to what I just showed you all. Number one, record the journal entry for the November 1st transaction. So for November 1st, transaction 1, accounts receivable - K Gates is going to be debited for $100. That's going to increase the balance in that account. Oh, that's an upward arrows. And the revenue is going to be credited for that same amount. That's going to increase that revenue account. So you could say it's sales revenue. Sure, I'll put on here sales revenue. Okay, on November 21st, that's when the cash was received. So we're going to increase the cash account by $100, decrease the accounts receivable account - K Gates by that same amount. This is going to eliminate this receivable balance that was initially recorded on November 1st. So this cash payment that was made matches the the sales revenue that was generated on November 1st. Okay. But going back down to here, or even up here, what if Kevin Gates doesn't make the cash payment? So the company has to do some things here. Now, there are different types of methods that companies use, pretty similar to the inventory costing methods, where inventory costing methods are provided as assumption methods to report the expense that went along with generating a revenue in the company's books and to figure out what the inventory balance is going to be. So this is pretty similar to that, because when it comes to accounts receivable, sales are made on credit or on account. Now, because of that, there's a risk of you not receiving that cash. So that's the risk by you not receiving that cash. But a good thing is, hey, when you allow credit sales, you're able to increase your recognition of revenue, because we have a lot of people out here that don't carry cash, and instead they'll use their, debit or credit card. So when they do that, you are opening up you open up the option or offering the option to pay in other ways. So aside from cash, you have credit. So it does, it allows you to increase your revenue, but the risk of that is, hey, things that are made on credit may not be settled with cash. So that's the risk, which is why you're given methods to try to combat that risk or to alleviate that risk. You're going to try to the best you can. So let me go to this tab. Let me zoom in here. And so in this tab here, this is an example of what to do when an account is not collectible by the customer. So one of the methods is called, let me scroll down here, it's going to be called the direct write-off method. Direct write-off method. So under this method, this is like a reactive method. So this reactive method, quote unquote reactive method, is when the company figures out that they're not going to be able to collect the balance from the customer, they react to it by going ahead and record the write-off in their books right then and there. So it's a reactive method. Now, because it's a reactive method, it is a non-GAAP method. Okay, GAAP is generally accepted accounting principles. So it's a non-GAAP method. So it's not appropriate under GAAP. Now, you're going to have, small businesses, even large businesses that will use direct write-off method. But typically, you use this method on insignificant amounts. So I put on here insignificant. Let me make sure I'm spelling this correctly. Insignificant amounts. Because the purpose of using this method only on insignificant amounts, in other words, immaterial amounts, is so that if you do need to do a write-off, it needs to be in these type of amounts, because you don't want to misrepresent the financial statements. You don't want to materially mislead, the financial statements or the company's financial records. So you don't want to make sure you're putting a dent in the financial records, which is why when it comes to using this direct write-off method, you want to make sure that you're not using it on amounts that are large, because if you do, then that could misrepresent a company's financial position, in their books. It can misrepresent how the company is performing. So it is a reactive method. It's non-GAAP, so it's not generally accepted accounting principle. And you use this method on insignificant amounts. And you can use this method, use method at any time. Which is another reason why it's a non-GAAP method. So if you're using it at any time, let's say you make a sale on credit and it's for $100 and you record the revenue in the month of January. We can say that in the month of February, well, not even that, March. We can say in March that you realize you're not going to be able to collect on that receivable. And once you determine that, you will go ahead and use the direct write-off method to record the uncollectible. Now, once you do that, you realize that when you record the uncollectible, well, you are going to be recording it as an expense. But since you're recording the expense in March, which is different from when you recorded the sale, the revenue in January, that pretty much presents a problem here, because the revenue that's generated, it doesn't match the expense that was recorded that is associated with the revenue that was generated. In other words, the expense that's recorded for this revenue is recorded in a different period. That's not good, because in the period of, let's just say, January, that expense that was recorded in March it's not aligned in the same exact period of when the revenue was generated, which is not a good thing, because under GAAP, you have to abide by what is called the matching principle, which means that when the revenue is recognized, let's just say in the month of January, the expense needs to be recognized in the same period as when the revenue was generated. That's per GAAP. So the direct write-off method goes against it, because you can use this method in the same period, but you also can use it at any other period or at any other time, which goes against GAAP. Because if you can record an expense that went with this revenue that was recorded in January and the expense was recorded in March, then you're recording this in two different periods. That actually misrepresents the financial statements, because how the company performed in January, well, you don't have an expense that matched that revenue there in that same period. Instead, the expense is shown, the bad debt expense is shown in March. That's a mismatch of or a misalignment of the financial performance of a business. Now, I know I'm kind of going off here, but when it comes to knowing how the company performs, you take your revenues and subtract out your expenses to get your net income in the same period or in a period of time. So again, this is why this is not an acceptable method under GAAP. So again, reactive method, non-GAAP, this is done on insignificant amounts, because if that happens, then it's not going to misrepresent the company's financials, because it's really not going to put a dent or make any big impact on the financial statements. And you can use this method at any time. All right. So I'm done with that. So here's an example here. Let me zoom. Okay. Hopefully you all see this. Yes. All right. So it's kind of cutting off here, but hopefully you can see this. So here's a scenario here that we're going to use the direct write-off method. So on November 1st, Bob made a sale on account to K Gates for $100. On December 31st, so you notice the two different periods here. So this is November 1st, and then this is December 31st. The customer, K Gates, did not make the full payment to Bob. It doesn't appear that the customer will pay. So on December 31st, the company, I keep saying company, Bob realizes or thinks that, hey, the customer's not going to pay. It's been 2 months. Number one, record the journal entry for the November 1st transaction. Number two, record it for the December 31st transaction. So on November 1st, if I zoom out here, yes, or zoom in, we see that to record the sale, debit accounts receivable K Gates for $100. Yes, that's going to increase the balance in that account. Credit revenue of $100. That's going to also increase the balance in that account. That's November 1st. On December 31st, this is when Bob determined that, hey, the full payment is just not going to be made. This customer is just not going to pay. Now, when using the direct write-off method, you are going to go ahead and credit accounts receivable for $100. You're going to eliminate that receivable balance. Okay? Once you credit the accounts receivable account, you're going to then debit bad debt expense by $100. That's going to increase the balance in bad debt expense. This is you using the direct write-off method. All right. So notice here that the bad debt expense is recorded in December 31st, which differs from the period of when the revenue was recorded. So this is why it goes against GAAP. But this amount of $100 is pretty insignificant. It's pretty small. Now, of course, it depends on the complexity and the size of the company. But in this case, this is Bob. We're going to assume that Bob is making a lot of money here, and $100 is it's not that much. So it is okay to use this method when it's just a little bit of money. It's insignificant in amount. But again, you notice that bad debt expense is recorded in a different period as when the revenue is generated. But these are the two accounts that are going to be used under the direct write-off method. Okay. The next one here, I added something to it. Let's see. There we go. There we go. Okay. So here's another scenario, but there's some addition to this scenario. So on November 1st, Bob made a sale on account to K Gates for $100. On December 31st, the customer did not make the full payment to Bob, and it doesn't appear that the customer will pay. Surprise, surprise, on January 10th, the customer, I actually say, hey, you know what, Bob, I know it took too long, but here's the full payment, Bob. So number one and number two, record the journal entry for November 1st and December 31st transactions. And number three, record the journal entries, plural, for the January 10th transactions. So for January 10th, there's going to be 2 entries that's required. So for the first 2 entries, I already did it there previously. We recorded the sale by debiting accounts receivable for $100, crediting sale revenue for $100. December 31st, recording the write-off or bad debt expense using the direct write-off method. We debited bad debt expense, credited accounts receivable. So we are directly eliminating the receivable. On January 10th, on January 10th, Bob received the cash payment from K Gates. So there's a couple of things that you need to do, or Bob needs to do, because Bob did write off the balance, or wrote off the balance on December 31st. First thing Bob needs to do is reinstate the customer's accounts receivable balance by first debiting accounts receivable for $100, crediting bad debt expense for $100. What this does is it reverses the previous entry here. That's what it does. It reverses that previous write-off here to reinstate the receivable balance and eliminate that bad debt expense. And then the second entry is to record the cash collection. So cash is going to be increased by $100. Accounts receivable is going to be decreased by $100. And that's it when it comes to the direct write-off method. So I don't want to spend too much time on this method here. Now, in the next video, in another video, I'm going to actually go over the allowance method, because there's a little bit more to the allowance method.